The Local Show, sponsored by Victory in Motion, home of knee repair, not knee replacement, on News Radio 570 WSYR, on 106.9 FM, and live everywhere on the iHeartRadio app. The Local Show features in-depth conversation with business owners, employees, and influential business leaders throughout Central New York, exploring their successes, challenges, and reasons for doing business right here in our growing community. The Local Show is produced locally by Zoe Advertising. Now your hosts, Tom and Steve.
Robert Rolfe is with us right now. He's a wealth manager at Excelsior Wealth Partners. How are you, Robert?
I am great. Thanks for having me, guys.
Well, thanks for coming back. We do appreciate that. Rob, you spent about 30 years running your own financial advisory firm before joining the Wealth Partners. What made you want to make the move?
I have not been presented with a better opportunity to truly be independent and manage money like the opportunity that was presented to me to join Matt and Matt.
Matt, no, there's two Matts.
Double Matt.
There's Matt as a CEO and Matt as a president.
Right. Yeah.
And I once had an intern named Matt, so we had three. We're up to three.
Triple Matt.
Yeah, triple Matt.
So why so different? Because you can't. I mean, there's a financial planner in every corner of every room, everywhere, and you are up in Oswego, in the Oswego area. So how was it different?
Well, if you look at the typical platform, there's a variety of places. There are, large broker dealers like, Morgan Stanley, like Wells Fargo, like Merrill Lynch, and they're all investment banks, right? They issue new stocks. They help companies go public. They issue new bonds. My town issued some bonds a couple of years ago for a water project in that manner.
Yeah.
With that being said, that's an important service. And they have tons of analysts, and they develop portfolios for people. And a lot of times there may be some of the home cooking in there, and that's fine. They own mutual fund companies and other things. But they don't necessarily want you to go and build a portfolio, which we do as a team.
Okay.
And at a place like Schwab, it's the same thing. They build things with Schwab ETFs and Schwab mutual funds, and they're not interested, in my opinion. And that's okay. That's a business model, and they're very successful business models. At an insurance company, they don't really want you to use a lot of individual stocks.
So they have a set way.
Yeah, and that's fine, and that's great in a lot of places. But as an experienced advisor, I was presenting with an opportunity to put my client first, create portfolios based on those needs. And again, we're simple guys. We focus on retirement strategies, wealth management, and financial planning. The client is in the center of all decision making and involved in all decision making. But we have the luxury of being able to use individual stocks, whereas everybody else wants you to use mutual funds and ETFs, and you're invested in everything at all times. Well, I like the S&P 500, but there's no way on earth that I like all 500 companies in the S&P 500.
Sure.
And it's not a knock. It's not a reasonable expectation.
What is an ETF, by the way? You said that last time you were on, and I wanted to ask you that.
I apologize. It's an exchange-traded fund, which started with very general indexes, bond indexes, S&Ps, things like that. And that's a great service because it's inexpensive. You
low
have
fees
less
too,
turnover.
right?
Yeah, inexpensive, low turnover, which is great for after-tax holdings. But ETFs have grown infinitely in the last 25 years. And now there is a plethora of things like thematic ETFs that may proliferate in an industry or a sector, and you can get people exposure. Things like quantum computing, which is blowing up, and quantum computers calculate things 400 to 600 times faster than normal computers. So picture where AI is going with that.
Yeah.
And that's a wonderful way to just take a small position and get exposure in some of those companies as they grow.
So you had said you put the customer first. You didn't say this, but my perception is that maybe that's not always true. I think maybe over the years some organizations put the commissions first or put the company first. I went to the Retire Ready CNY workshop here a month or two ago and learned a lot. I learned a lot, and it really feels like you guys have the sweet spot of people are retiring or recently retired. And the one thing I heard a few things. One thing I heard was you pretty much guarantee lower fees, and people don't know the fees that they're paying. Explain the fees a little bit there.
Absolutely. Mutual funds, exchange traded funds all have fees, and if you're right, ETFs fees are considerably lower than mutual funds. Mutual funds are over 100 years old now. They brought investing to mainstream America. Without that, there wouldn't have been 401ks with investing. And that's great. The Massachusetts Investment Trust was the first mutual fund ever invented by Massachusetts Financial Services in Boston in 1924. And they were the soup du jour. When I came into this business in 1994, the average person would just buy mutual funds in their 401k, or in the instance of, we live in a community where there's a lot of small businesses. Small business owners would load up on shares from various mutual fund providers. The problem is that the expenses are high, there's a lot of turnover, and that's not always great. If you can find something with a more refined palette, like an ETF, again, maybe pinpoint your investing prowess a little bit and choose where to be, you can save the client money. By using individual securities, they have no operating expense.
And what was explained at the workshop is so those monies go back into investing, and you take a point or half a point here or there, and it makes a big difference in the long run.
Over a 10-year period, it can be tens of thousands of dollars.
Real quick, tackle the simple question of when should someone take Social Security? I know you're all about that, so
that's okay. I would say that the preferred option would be to wait as long as possible, because Social Security promotes an 8% raise every year beyond 62. You can actually wait all the way to 70, and I've had probably 9-10 clients wait until 70. Maybe there was an age discrepancy in the spouses. And if one of the spouses passes sooner than the other, which is likely, the remaining spouse gets to choose the higher Social Security benefit. Well, guys typically don't live as long as ladies. And in some cases, maybe the wife, raised kids, did various things, and didn't work as long, doesn't have as many credits. And that's a great way to preserve their income.
And it goes up 8% a year.
Yeah.
So it's a calculation. And one thing that, last thing I'll share, at the workshop that you guys did, I learned a lot of things, but I learned there's a formula. There's like 5 or 6 things that matter when you decide. That has to do with your savings, has to do it. And the thing about, you don't want the market to tank the first few years that you retire, because that affects everything, but you create strategies to buffer that. But Robert Rolfe, wealth manager at Excelsior Wealth Partners, ExcelsiorWP.com, or I know you can go to Retire Ready CNY. That's easier for me to remember. RetireReadyCNY.com. We appreciate you joining us today.
Thank you, and I appreciate your hospitality.